Why buy now, pay later? Plans are threatening banks and credit cards. The financial landscape is undergoing rapid transformation, and few trends have had as significant an impact on traditional banking and credit systems as buy now, pay later, BNPL programs. What began as a convenient e-commerce payment option has since transformed into a global movement that is revolutionizing the way consumers manage debt, borrow, and spend. Today, millions of individuals worldwide prefer to divide their purchases into smaller, interest-free installments rather than relying on conventional credit cards. However, this convenience is masked by a much more profound transformation that has the potential to disrupt the psychology of consumer finance as well as banks and card networks. The emergence of a new credit revolution. The fundamental idea of BNPL is straightforward. Consumers are permitted to make payments for products in smaller increments, typically over the course of weeks or months, without incurring interest penalties, provided that the payments are made punctually. PayPal's Pay and $4, Klarna, Affirmi, and Afterpay were pioneers in establishing the system as a mainstream option. Apple and Amazon have now introduced their own BNPL models, indicating that the culture of installment payments is here to stay. BNPL served as an ideal intermediary between credit and cash during the pandemic, as online purchasing experienced a significant increase and consumer budgets were constrained. It provided flexibility without the stigma or complexity associated with assuming debt. $700 billion is anticipated to be exceeded by global BNPL transactions by 2025, thereby acquiring a progressively larger portion of the market that was previously dominated by credit cards. The danger to credit giants and traditional banks. Credit cards were the primary source of consumer financing for decades. They were the most profitable product for banks, generating billions in interest and fees annually. However, the equation has been altered by BNPL. Revenue is generated by banks through revolving debt, which is incurred when individuals maintain balances and pay interest. Conversely, BNPL frequently imposes zero interest, which directly impacts that revenue stream. Traditional credit scoring systems are also bypassed by BNPL companies, which employ their own proprietary algorithms to evaluate repayment behavior and spending patterns in real time. This provides them with a significant advantage in attracting younger consumers who may not have robust credit histories but are still highly active spenders. In conclusion, BNPL platforms have established a parallel financial system that is more enticing to digital native generations, as well as more efficient and hassle-free. The reasons why consumers are opting for BNPL instead of credit cards. It is possible for conventional credit cards to appear antiquated and punitive. Many consumers are apprehensive due to the complex billing cycles, compounding interest, and late fees. In contrast, BNPL is perceived as transparent and equitable. A predetermined sum is paid on specific dates, and that is it. The appeal extends beyond mere convenience. BNPL provides the following services. However, the narrative is not entirely optimistic. Critics contend that BNPL has the potential to promote overconsumption by making it too simple for individuals to purchase items they cannot afford. In the absence of adequate regulation, certain consumers manage numerous BNPL accounts on various platforms, resulting in invisible debt that is not visible in conventional credit reports. Late fees and skipped payments can accumulate rapidly, and as regulators catch up, companies are being encouraged to disclose more detailed terms and implement affordability checks that are comparable to those employed by banks. Financial watchdogs in the United Kingdom and Australia have already implemented regulations that are more stringent. The Consumer Financial Protection Bureau (CFPB) in the United States is investigating the management of data privacy, fees, and repayment behavior by BNPL corporations. The issue is whether BNPL can preserve its reputation as a friendly alternative to credit cards as a result of the beginning of more stringent oversight. The counterattack on banking. Banks are not passive. The behavior of BNPL has been imitated by major credit card issuers who have implemented post-purchase installment features. The speed and appeal of BNPL fintechs are challenging to fully replicate due to their reliance on interest-based revenue models, sluggish innovation cycles, and legacy systems. The long-term business model of BNPL. BNPL's no-interest structure appears to be unsustainable at first inspection. However, the key is in the merchant fees. Retailers pay BNPL providers a fee of 3 to 6% of the transaction amount, which is significantly higher than the typical credit card processing fee. For what reason? Sales are stimulated by BNPL. Merchants are willing to compensate customers who are 20–30% more likely to conclude a purchase with installment options. BNPL companies also benefit from partnerships with financial institutions that license their data-driven risk systems, premium features, and late fees, which may result in the emergence of BNPL banks that combine the best of both realms through mergers and acquisitions. The comprehensive economic perspective. The fragmentation of finance is a broader global trend that is reflected in the development of BNPL. Consumers are no longer devoted to a single bank or product. They desire solutions that are transparent, customized, and available on demand, and that are compatible with their digital lifestyles. In the same way that streaming disrupted the cable monopoly, BNPL is disrupting the credit monopoly. However, this democratization of finance is not without its consequences. The potential for misuse increases as credit access becomes more frictionless. Economists caution that a significant increase in BNPL defaults could have a significant impact on the retail and fintech sectors, particularly in countries where household debt is already high. However, the model is expected to develop rather than vanish. The next frontier may involve subscription-based BNPL for recurring expenses such as travel, healthcare, or education, which would further blur the distinction between borrowing and expenditure. By establishing hybrid credit systems that are more flexible, intelligent, and secure than either model would be individually. Nevertheless, the psychological transformation is irreversible. Individuals have experienced the liberation of paying on their own terms. Financial institutions must either adapt or perish when consumer behavior undergoes significant changes. The future of borrowing. BNPL's status as a niche convenience or an enduring pillar of the global economy will be determined over the next few years. Regulation, consumer discipline, and the profitability management of fintechs are all significant factors. It is a fact that conventional banks cannot continue to rely on the assumption that consumers will automatically swipe their credit cards. The game has transformed. Buy now, pay later is not merely a payment method, it is a paradigm in an economy that is fueled by digital trust, speed, and flexibility. Before your departure, if you found this analysis to be insightful, please remember to like, share, and subscribe for additional in-depth analyses of global business trends that are influencing the way we spend, borrow, and live.